You weren't supposed to hear this. While headlines distract you with noise, while retail traders argue about candles and influencers shout about the next 10x, something far more calculated just happened in the shadows of Paris. On February 13th, behind closed doors, the Morpho Association signed a cooperation agreement with affiliates of Apollo Global Management. And if you think this is just another corporate press release, you're already playing the wrong game. Because when a global alternative asset manager with hundreds of billions under management quietly positions itself around a governance token in an on-chain lending protocol, that isn't marketing. That's strategy. That's positioning. That's the kind of move that happens before the narrative changes. If you want real financial truths they don't teach, hit subscribe and turn on notifications. You don't want to miss what's coming. Here's what most people will see. They'll see that Apollo may acquire up to 90 million Morpho tokens over 48 months. They'll see words like open market purchases, over-the-counter transactions, transfer restrictions, ownership caps. They'll think stability. They'll think partnership. They'll think validation. But sophisticated capital doesn't move for validation. It moves for leverage, optionality, and control over future liquidity flows. And the moment you understand that, you stop reading announcements like a retail trader and start reading them like a predator. Let's slow this down. Morpho operates an open on-chain lending network. That means capital flows without traditional intermediaries. That means algorithmic matching between lenders and borrowers. That means yield, credit infrastructure, vault curation, governance rights. And governance is where the real power hides. Morpho token holders influence how the protocol evolves, how risk parameters adjust, how incentives are structured. In decentralized systems, tokens are not just assets. They are voting machines. They are steering wheels. They are quiet levers of influence over billions in potential credit expansion. Now layer Apollo into that picture. Apollo is not a meme fund. It is not a crypto-native startup. It is a publicly traded global alternative asset manager headquartered in New York, spanning private equity, credit, real assets. It operates in the world of pension funds, sovereign wealth funds, insurance balance sheets. It understands debt markets at a scale retail investors can't even conceptualize. Credit is its bloodstream. Structured finance is its native language, and now it's stepping into an on-chain credit protocol with the option to accumulate up to 90 million tokens over 4 years. 4 years. That timeline alone tells you this is not speculation. This is positioning across a cycle. Because here's the hidden layer most people ignore. We are in a period of silent asset repricing. Currency debasement isn't loud. It doesn't knock on your door. It bleeds purchasing power slowly. Inflation decays value. Governments issue debt. Central banks engineer liquidity waves. And every time liquidity expands, assets reprice. The question is never whether money moves. The question is who positions before it moves. When an institution like Apollo explores token acquisition via open markets and over-the-counter transactions, capped but structured, that signals accumulation strategy. Open market purchases create price signals. OTC transactions minimize slippage and visibility. Ownership caps and trading limits are framed as market stability mechanisms. But stability is often the narrative that makes accumulation socially acceptable. Institutions don't chase green candles. They build exposure while narratives are neutral and volatility is manageable. Think about the psychology. Retail traders chase momentum. They buy breakouts after media narratives confirm safety. They sell bottoms when fear peaks. They are trained to react. Institutions design conditions to accumulate before reaction begins. They understand liquidity traps. They know how thin order books can amplify moves. They know that governance tokens in early-stage infrastructure protocols are often mispriced relative to long-term cash flow potential. Morpho's protocol focuses on lending markets, curator-managed vaults, credit infrastructure. Credit is the engine of every financial system. When credit expands, economies grow. When credit contracts, assets crash. On-chain credit infrastructure is the crypto equivalent of plumbing. It's not flashy, it's foundational. And foundational layers tend to be where generational wealth is built quietly, long before retail attention arrives. Now consider the cap. Up to 90 million Morpho tokens over 48 months. That is a ceiling, not a promise. It creates optionality. Apollo can scale in as the ecosystem matures. It can observe liquidity depth, governance evolution, regulatory clarity. This is phased exposure, strategic patience, the kind of patience only available to capital that doesn't need immediate returns to survive. Galaxy Digital UK Limited acted as exclusive financial advisor to Morpho on this transaction. That detail matters. Advisory alignment means this wasn't impulsive. It was structured, modeled, stress-tested. Galaxy operates at the intersection of institutional finance and digital assets. That bridge is where legacy capital transitions into programmable systems, and transitions create arbitrage windows. Windows close when retail finally understands what happened years earlier. But here's the twist nobody is talking about. Ownership caps and trading restrictions are framed as safeguards, and they likely are, structurally, but they also slow visible concentration. They prevent sudden dominance narratives. They create the appearance of decentralization continuity, while institutional exposure builds gradually. In markets, perception management is as important as capital deployment. Media narratives are engineered around comfort. Fear and greed are calibrated. The herd must feel safe enough to participate, but not informed enough to front-run. Most retail investors operate inside psychological cages. They are conditioned by price volatility. They measure success in weekly returns. They confuse noise with signal. Meanwhile, whales and institutions analyze multi-year liquidity cycles. They understand that the next expansion of on-chain credit will not look like the last bull market mania. It will look like infrastructure integration, real-world assets tokenized, institutional collateral flowing into smart contracts, governance tokens accruing influence as credit volumes scale. And here's the uncomfortable question. What happens when traditional credit giants decide that on-chain systems are not experiments, but extensions of their balance sheets? The line between centralized and decentralized finance begins to blur. Curator-managed vaults become institutional pipelines. Yield products become structured offerings. Governance tokens become strategic assets. This is where silent wealth transfer happens. Not in parabolic retail rallies, in gradual repricing of infrastructure layers before mainstream awareness catches up. By the time influencers scream about institutional adoption, the positioning phase is already complete. The liquidity will be provided by retail. The exit strategies will be invisible. Look at the timing. The agreement spans 48 months. That horizon likely overlaps with macro cycles, potential rate adjustments, shifts in inflation expectations, regulatory frameworks evolving around digital assets. Institutions plan around macro inflection points. They don't gamble on headlines. They model scenarios. They prepare for both expansion and contraction. Imagine a scenario where global liquidity tightens briefly, creating fear in crypto markets. Retail sells governance tokens to protect capital. Price compresses. Institutions with long-term mandates accumulate through OTC desks. Transfer restrictions maintain orderly markets. Media narratives focus on volatility risk. But beneath the surface, token distribution shifts. Influence consolidates among those with patience. Now imagine the opposite scenario. Liquidity expands. On-chain lending volumes surge. Credit demand increases. Yield becomes attractive in a world still hungry for return. Governance tokens that influence vault parameters and risk frameworks suddenly matter more. Market participants realize that control over credit infrastructure is control over yield pathways. Prices reprice upward. Retail rushes in, fueled by FOMO. And the early accumulators sit on asymmetric exposure. This is not conspiracy. This is capital dynamics. The human mind is the real battlefield. Fear triggers selling. Greed triggers chasing. Media amplifies both. But institutions exploit neither emotion directly. They exploit the predictability of those emotions. When announcements like this surface, retail either dismisses them as boring or overhypes them as immediate moon catalysts. Both reactions are exploitable. The disciplined approach is analysis of incentives, structure, and timeline. Apollo's diversified platform across private equity, credit, and real assets means it understands collateral valuation deeply. On-chain lending protocols rely on collateralized borrowing. Risk models determine liquidation thresholds. Governance decisions influence these parameters. Exposure to governance tokens provides insight and influence over those mechanics. That's not just passive investment. That's strategic integration into a parallel credit system. And let's address the broader macro context. Global debt levels remain elevated. Governments continue to manage fiscal deficits. Currency purchasing power continues to erode over long arcs. In such environments, capital seeks yield and structural advantage. Digital asset infrastructure offers programmable, transparent, globally accessible credit markets. If those markets mature, early governance participants benefit disproportionately. But here's the warning. Institutional involvement does not automatically mean retail wins. Institutions are not charities. They are optimization machines. If Apollo accumulates tokens responsibly within caps and restrictions, it still gains exposure to governance influence and potential upside. Retail participants who fail to understand dilution, emissions, incentive structures, and competitive protocols may misprice risk. They may assume partnership equals guaranteed appreciation. Markets punish assumption. Liquidity cycles are brutal. They expand slowly, then contract violently. In contraction phases, only capital with conviction and long duration survives. Retail often capitulates at the worst possible moments. If you understand that this agreement is a multi-year chess move, not a short-term pump signal, you align your expectations accordingly. This cooperation is framed around strengthening lending market development, credit infrastructure, and curator-managed vaults. That language signals focus on scalability and risk management. Mature credit systems require deep liquidity, diversified collateral, robust governance. Institutional participation can accelerate those layers, but acceleration also attracts regulatory scrutiny, competitive pressure, and innovation races. So ask yourself, are you reacting to headlines or are you mapping structural shifts? Because structural shifts rarely announce themselves loudly. They whisper through agreements, caps, advisory mandates, and phased acquisition rights. They unfold over years. They reshape who holds influence before the public realizes influence shifted. The real power move here isn't the headline, it's the option. The ability for Apollo to acquire up to 90 million tokens across 48 months creates strategic flexibility. If Morpho's ecosystem underperforms, exposure can remain limited. If it scales aggressively, exposure can expand within predefined boundaries. Optionality is one of the most valuable assets in finance. Retail traders rarely have it. Institutions design it into contracts. And remember, governance tokens are often undervalued because their utility is abstract. Voting doesn't feel like yield. Influence doesn't feel like cash flow. But when governance steers parameters that influence billions in lending volume, influence translates indirectly into economic advantage. The market frequently misprices indirect value until it becomes obvious. This is where media narrative engineering enters. Early coverage will focus on validation and partnership. Later coverage may focus on institutional adoption trends. Very few outlets will dissect accumulation mechanics, ownership caps, OTC structuring, and multi-year strategy. Complexity shields intent, simplicity drives clicks, and retail consumes simplicity. But you're not here for simplicity. You're here to see the machinery. The machinery says this: legacy credit expertise is probing on-chain credit infrastructure. Accumulation pathways are formalized. Advisory bridges are established, exposure is capped but meaningful, timeline aligns with macro cycles. Governance influence is part of the equation. That combination is not accidental. The deeper reveal is this: the future financial system will not flip overnight from traditional to decentralized. It will merge, hybridize, institutions will test, integrate, influence, and gradually normalize on-chain mechanisms. Those who position early and foundational layers may benefit. Those who chase narratives late may provide exit liquidity. And here's the final twist. The agreement emphasizes transfer and trading restrictions to promote market stability. Stability reduces volatility spikes. Reduced volatility attracts conservative capital. Conservative capital increases depth. Increased depth legitimizes infrastructure. Legitimacy attracts more capital. It's a feedback loop. If managed carefully, it transforms experimental protocols into core components of financial plumbing. But nothing is guaranteed. Protocol risk exists. Smart contract risk exists. Governance conflict exists. Regulatory intervention remains unpredictable, and markets can remain irrational longer than retail patience can endure. So what do you do with this information? First, you stop thinking in weeks. You start thinking in cycles. Second, you analyze token distribution, governance proposals, vault growth metrics, credit volumes. Third, you monitor institutional behavior not for hype, but for consistency. Are acquisitions occurring steadily? Is ecosystem liquidity deepening? Are risk parameters evolving conservatively or aggressively? Because if this is indeed early institutional positioning within on-chain credit, the next major liquidity wave could reprice governance layers dramatically. And if it isn't, then disciplined analysis protects you from blind optimism. This isn't about worshiping institutions, it's about understanding them. They don't fear volatility the way retail does. They design around it. They don't chase pumps. They accumulate where asymmetry exists. They exit quietly when crowd euphoria peaks. The Morpho and Apollo cooperation agreement might look technical, it might look procedural, but beneath the surface, it signals something deeper. Traditional credit power, acknowledging programmable credit infrastructure as worthy of structured exposure. And once traditional credit power acknowledges something, it studies it. Once it studies it, it models it. Once it models it, it positions. The question is whether you will simply watch the positioning unfold or whether you will study the structure yourself, because the next wealth transfer will not announce itself with fireworks. It will move through governance votes, vault allocations, collateral ratios, OTC desks, and 4-year accumulation windows. It will reward patience, punish impulsiveness, and expose who understood the game early. Most people will scroll past this. They'll wait for louder signals. They'll chase trends when media screams certainty. But by then, optionality will be priced in, influence will be distributed, and the asymmetry will shrink. This feels illegal to know because you're not used to reading between lines. You're used to reacting to headlines. Change that, and you change how you see money. So here's my question to you. When institutions position quietly over 48 months while retail debates daily price action, who do you think is preparing for the next cycle? Drop your answer in the comments. I read them. Send this to someone who needs to hear it. And if you're serious about understanding the systems behind the markets, not just the charts, subscribe and turn on notifications, because the next move won't come with a warning.